All right, we're going to go ahead and get started because we have lots of great information. Hi, Marquita. I know you're on there. Thank you for joining. Yes, you all, my name is Aretha Higgins, and I am the Senior Housing Counselor with Dallas Habitat. And I am so happy to see you all joining us this evening. I know that, it's late in the evening. You all have worked and have had a long day. So for you all to take time out in your evening and come and get this information, we really appreciate you. And I'm sure you're going to enjoy it and get lots of great information. So much stuff is going on right now with everything just being so expensive, with groceries to gas. It's just life itself. And so everybody's trying to find a way to be able to save money and be able just to manage your finances. And we have Mr. Devin Scatini with Comerica Bank, and he's gonna help us navigate through some of these things this evening. He's going to discuss the most effective ways to grow your savings, even on a tight budget. Okay, so it's going to be lots of great information, and I want you all to take notes, because again, if any of you have been in my counseling sessions, you know that Aretha Higgins always stresses save, save, save. Pay yourself first, because life happens to everyone, and you want to be as prepared as possible, right? So with that being said, I'm going to turn it over to Devin, and he can introduce himself, tell you all a little bit about himself. Again, he's with Comerica Bank, and let's just say welcome to Devin, okay? You all can put that in the chat.
Well, thank you very much, Rita. I appreciate it. Yeah, Devin Scatini, and as you noted, with Comerica Bank. So I'm on the credit side of the bank, and work primarily with companies that are trying to get loans for whether it's working capital purposes or equipment loans, things like that. And I work with our folks on the line on a daily basis that are customer facing as to how to provide credit for companies in various industries. I'm actually located in California. I'm in the Bay Area, in Silicon Valley. So I really appreciate the opportunity to come in and actually speaking with another region too. Actually, I'm coming down to Dallas next. I'll be down in the state next or 2 weeks, I guess. So looking forward to my visit. But yeah, I agree. There's obviously, as you noted, a lot going on, and has been actually for the last year, and it's hitting all of us in our pocketbook, and so this is a great time, especially starting off the beginning of the year, just to rethink about how we are saving. But first of all, I want to extend out and congratulate all of you guys, because you've made the first step by attending something like this, right? So that's step number one, and so congratulations. And I think what we're gonna be talking about is taking that first step, as far as thinking about saving money, why it's important, and how to come up with a savings plan. And it's going to be different for all of us, because we all have different situations, obviously. But with that, maybe we'll go ahead and move forward, Aretha, with the deck here. Are you able to?
Yes, I'm going to share my screen. Just a minute.
I apologize ahead of time to Aretha. I said, I'm just not, I can't multitask enough to be able to go through it and manage the deck at the same time. So she graciously agreed to run the deck at the same time that I'm going through this. But so obviously, we're talking about savings today. We can move to the next slide and talk a little bit about, exactly what savings, what we mean by saving. Go ahead and forward it through to the next slide, and actually even to slide 3 here.
Slide 3. Okay, Devin, can you tell me what you're actually seeing? Are you seeing your savings deck slide?
Yep.
Okay, all right.
So it's slide 1. So slide 2, we're gonna talk about a little bit about what is saving. And obviously this is what we want you to be thinking about. We're setting aside money every time that you're you're getting income. And so it's a regular basis, every paycheck, every time you're getting something. We're taking a little bit of a small amount with, and like I said, everybody's different, and can afford to do different things. But as we'll see when we get through our later in the presentation, how that can add up and be material as we are saving over time. So every small amount makes a big difference. Go ahead and move it forward, Rita. What does savings mean? Go ahead and move it forward one more notch here, but I think it's different for all of us. Like I said, I think the first thing we want to do is, we talk about on this slide, you're only saving if you didn't spend it. So I think a big thing about setting aside money on a daily basis, on a weekly or bi-weekly or monthly basis is, we've got to be able to first examine our budget, examine our expenses. And I think if we sat down, take the time to sit down and think about and write through, here's my weekly expenses, here's my monthly expenses, and by looking at that, we can say, okay, these are payments, and we can categorize them as far as these are payments I have to make on a weekly basis, I have to make on a monthly basis, and where's my discretionary spending. So I think the first part of this is being able to come up with a budget, make a plan, and see what in this is discretionary. Where can I spend less money? I mean, for me, I know at one point in time, I got in the habit of getting a Starbucks coffee every morning. There were some events in my life that changed from a financial perspective, and I went through that scenario that I just explained, and sat down and wrote out all my expenses, once categorized them based on I have to make these versus what was discretionary. And the Starbucks account came up, and it was like, I'm spending $3 a day on Starbucks. Do I really need to be doing that? And you start multiplying that out. Well, that's $90 a month. That's close to $1,000 a year. And as we'll see when we get through the deck here, as you start to, if you're able to save something like that, it can add up over time to some material savings. And go ahead and move it along there, Rita. Next slide talks about, why I'm looking at slide 6, I guess. This is the back one. There you go. So different reasons as to why we save. And once we have come up with our budget and where we think are discretionary, then we need to think, well, what are we saving for? Are we saving, there's specific financial goals we have to build wealth for emergencies. Obviously time with less income or more expenses has happened to all of us in the past. We can categorize our goals and into which we're trying to accomplish as to the timeline in which we need to have those savings available to us. Are they short-term, mid-term, or long-term goals? So I think we after our budget, we look at then what's discretionary, and then what are we saving for, and what are the goals? Are they short-term goals, mid-term goals, or long-term goals? And that help classify how we look at savings in addition to that. So moving on to the next slide, slide 7. Again, just kind of a key takeaway, reaffirming, setting aside some money once we go through that planning that I just alluded to. It can make a big difference, even in my example with regards to Starbucks along the way, where even the littlest amount, whether it's daily or weekly, that you can set aside can increase it over time to be material and help with your savings goals. Okay, let's move along to the next slide as far as talking about where we build our savings and how to do that. I think the things we want to consider here are what are our different avenues for how we save, where we hold those savings, advantages and disadvantages, and as to how we look at that. I think if we look at the next slide, we can talk about a few different areas as to, we've got a lot of different options, especially in this marketplace, whether those are institutional with banks, with non-banks, with friends and family, et cetera. Some of those examples are in the next slide here. Talking about where do we, once we have created and start to save, where do we put those savings? What are the best places? And that may be determined based upon everybody's individual circumstances, and it can change. And or once we've figured out what the goal of our savings is, it could change as far as where we put our savings too. But obvious examples here that we've pointed out, whether it's at home or with a friend or family, it could be a prepaid card, rotating savings and credit associations, or more of a traditional savings account at a financial institution. So let's talk about, go ahead and move on and talk about, a couple different, advantages and disadvantages to a couple of these places where we may want to save. Home is the first one that we come up on the slide here. I think, you can see the advantages and disadvantages, advantages being, there's no rules, no fees, no costs. It can be convenient and easy to access at home. I think the disadvantages here are laid out. Obviously it can be lost or stolen, destroyed by various means. And you'll notice that there's easy to access on both sides, advantage and disadvantage. I think of this as, look, for me personally, and it's different for everybody, is if it's something that I'm saving for kind of midterm or long-term goals, think of it, I'm a connoisseur of chocolate chip cookies. If it's sitting out on the counter, every time I go by, I'm going to grab one. And that's how I kind of think of savings being left at home. And it's just too easy for me. It is an advantage, but it's more of a disadvantage for me personally. And it's too easy to use those funds for something I might need at immediate times, where if it's somewhat out of sight anyways, as far as from the easiness perspective, I've got a better chance of being able to save that for a longer term event or whatever my financial goals are. Let's move on to the next slide here with regards to friends or family. It talks about some of the advantages and disadvantages here. A lot of the same advantages as far as from a cost perspective, and convenience. And we note that, it may keep you from a family member or friend may keep you from spending those funds. Disadvantages are very similar also. I think big picture, when you think about this option though, is that from my personal perspective is money with friends and family can cause, relationship strains, and that's one of the disadvantages. And for a variety of different reasons, and I'm sure a lot of us have experienced those in our lifetime, but it just does when you get money involved. And so if that piece, holding it with somebody else, creates for me more risk from a friendship perspective and from being able to access my money when I need to than I would like to have. You go to the next slide. We talk about prepaid cards. I think there's obviously advantages here, and it talks about the easiness of it, to being able to use it from a functionality standpoint makes sense. Convenience of it, you can possibly have it wages from your employer, automatically move on to the card. There can disadvantages are the fees. Still, you can get stolen or lost. it's not insured by any sort of financial institution or the federal government. It's sometimes can be more difficult to move these monies once you put them on a prepaid card, or it could be expired. So I think this is possibly a little better avenue than the prior two that we talked about, as far as home or with friends. But for me, again, personally, boy, if I have it on a prepaid card, I lose stuff all the time, and I would easily lose a prepaid card, and I would hate to feel I had some amount of my savings on that prepaid card that all of a sudden disappeared because I can't keep track of it, and that does happen to me all the time. I think that the other aspect of that is it is still pretty easy to use, but where it would be too easy for me to use in a weak moment on something that maybe it wasn't in my financial goals. But I think it does serve a purpose. I think, again, going back to prioritizing your goals in short-term, mid-term, long-term. Maybe this is something that you could use for short-term goals. And again, it goes back to, each of our own priorities. And for me, it's not necessarily the best tool, because I wouldn't trust myself as far as I'd lose it. I know I'd lose it. My wife is already killing me over the things that I already lose. So I can't keep track of my car keys half the time, or my wallet anyways.
That would be me, Devin.
Yeah. Yeah, so I'm good. I'm glad I'm not the only one.
No.
If we move to the next one, we talk about kind of a rotating savings and credit association. I don't know how popular this is, honestly. I don't hear too much of this. I'm sure it's prevalent out there, more than I probably am familiar with, but you're talking about coming up with an agreement with a group of colleagues, friends, associates, what have you, to save money, and so that it can be accessed, and you can probably get somewhat of a better return, probably because of the lump sum of money you're putting together, or there's a potential of that. But to me, the disadvantages of it, outweigh some of the advantages, and I think one is that you just don't. Are they using these funds just for returns, or are they potentially lending those funds out to back to individuals that are participating? If they're lending it, what if that participant that's getting the loan isn't able to pay back? What happens to my funds? How do I get repaid? There's some other challenges with that. When I think about my financial goals, and money being there that I've achieved, I want to make sure that money is there for me, and I'm not reliant. I'm reliant on maybe a little bit more of a regulated institution that I know and my funds are there when I need them for whatever purpose. Right. So the last option we talk about is a traditional savings account, where you have FDI insurance. So that's the federal government guaranteeing that your funds are there up to $250,000, which is a lot of money. With the ability, a lot of times you can set up with your employer the ability to make sure that those funds are directed right into your account. You have the option of being able to potentially, at most institutions, have something where you have a separate savings account versus more of a traditional checking account, to be able to move monies back and forth easily. So there's probably more options there. They talk about the online. For some of us, you use a lot of online things with our phones or computers to move money back and forth between accounts. So capabilities of doing that. Now, some of the disadvantages are typically, nobody's doing this for free. So there is some amount of reoccurring fees. And so that's something that you really need to look into ahead of time, based upon what kind of, how much your goals are, and what kind of, when we'll get into more later, but annual percentage rate, or I should say annual percentage yield actually, that you will get on that versus the underlying fees associated and what your investment goals, savings goals are. If it's real short-term goals, it may not, and the fees aren't, you're making enough in the account where the fees aren't excessive, then it might make sense. For longer term goals, you might want something more than that from a return that you're getting on your savings, and really focused on the fees there also. Other places, next slide, we can talk to as far as potential opportunities, money market deposit accounts. Typically on money market deposit accounts, it's a type of account at a financial institution. So a lot of times you will have the same insurance there to support those accounts, and you can get a higher yield or annual percentage yield on those monies. But a lot of times those will come with minimum balances that can be, depending on where we are with the starting of our savings, can be a little bit on the higher side depending on the institution. Certificate deposits, those are typically guaranteed certain levels of interest rate associated to them. Drawbacks are is you're locking up those funds for a certain period of time. Usually it's like 6 months to a year. So you got to be confident that you won't need the funds. You can get higher returns on it, but you got to be confident that you won't have to use those funds in that period of time. And similar with savings bonds, but obviously if you're going to retirement accounts, if your employer offers some sort of retirement account, and a lot of employers will offer benefits for you to use that, meaning they may even match a portion of what you put into your employment account as your retirement account. You're leaving by not contributing or some piece of that, you're leaving potentially free money on the table besides what you could earn from interest rates, especially if your employer will match a certain percentage of. You got to make sure that you are looking into that, because that's free money from your employer, really, and it goes towards your typically your longer term goals of the financial goals that you want to achieve. And then for our longer term goals, where some of our employers don't offer plans, there's IRA, which are individual retirement accounts, that we can also explore. And again, these are more typically for longer terms, towards, you're looking at later years of your life when you're looking at retirement and no longer employed, trying to build up those savings to support yourself at that point in time. There's obviously, lastly on this slide, we talk about investments, equities being stocks and corporate bonds, etc., which for me, those are always great opportunities, but there's more risk, right? There's more risk, and as we've seen, if you follow the market at all, you can see every day markets up and then down, and usually individual stocks, etc., follow those trends. And so depending on your goals, and how much risk you can have in those goals, meaning, do I need that money at the end when my date comes up? If I need money, part of my financial goals is to try to reach, $1,000 in 5 years for a specific event. Maybe these stocks and bonds might not be the best investment for me, because my $1,000 might be worth $500 then, or, but it could be worth quite a bit more too. You just never know. But I need to know for a shorter term horizon with my goals that my money is going to be there and planning to the dollar amount. So there is a place for investment in stocks and bonds, but it's different for everybody depending on your financial situation. talking about deposits and insurance, this we kind of alluded to. You know, any bank, I mean, you should look for these type of, you know, any financial institution. They will be identified as to whether their deposits are insured by the FDIC, and that and what that insurance limit is, and same for credit unions. So those are the safest place as far as if there's something material that happened in the economy, we'd have to go back years for this to happen or to experience it. But there was times when you know there was demands on financial institutions' money, and if for some reason they couldn't honor your deposits that you wanted to withdraw, you're guaranteed by the federal government that your money is safe, and you will get that money back when you demand it. Okay, this is the real fun part if you're a finance geek like myself. Talking about interest and compounding, the benefits of compounding your interest. So if you may or may not know, but when we talked about looking for opportunities for savings in which you can get an interest rate on your deposit, the benefits of doing that is the savings accounts typically compound. So today, and we'll go through some examples, there's benefit to investing in compounding interest rate accounts because you're getting paid on the interest in which you've received the prior month or the prior year or what have you. If it continues to stay in that account, you're getting paid interest on top of interest. And that is material as the longer you're able to leave the money in the account and compound versus not having it in some sort of a financial institution where it's earning interest. We can go to the next slide for an example. And you talk about, you know, kind of what I say, old school, leaving that money under your mattress here versus having it in an account where it's earning interest. Besides some of the risks we talk about keeping your money at home, it's not growing. Your money is not growing with interest here, and so you know whatever you put there, it's going to be. Yeah, exactly. So whatever you put there is not going to increase in value. And as Rita alluded to with inflation, you know, the cost of our daily goods going up, it's actually losing value. It costs more for a loaf of bread today than it did a year ago or 2 years ago. And so, you know, if inflation is going up, you know, they'll say on average, it's been more than this recently, but 3% annually, and your buying power with $1,000 has went down year over year without trying to keep up with inflation. So the example here shows, you know, if you're getting paid 2% compounded monthly, what the difference is. So you get a little over $1,100 over 5 years, and $1,200 over 10 years. So that's a material difference just by where you're housing and locating your savings. Let's go to the next page here. We give kind of a little bit more, another example here of interest rates combined with adding a monthly savings of $5 a month. So the example here, you start off if you're not having it in some sort of financial institution where you're earning interest on it at the end of this goes all the way to 30 years, but you're only going to have what you have saved, which is a great starting point. What this is shown that you're disciplined enough to save $5 a month, obviously, and what that value will be over time. But you look at it as compared to compounding interest rate, even at only 2%, and there's a material difference, especially depending on, you know, if these are funds that you're looking at for longer term horizons and planning, past 10 years or whatever, you start to get some material differences in the compounding interest rates here. Moving on to the next slide, we can talk a little bit about annual percentage yield and what that means. When you're looking at putting your money into a financial institution, they have to show you what they call API, which is the annual percentage yield, what you'll make on that account. And it's different. It's what the interest you'll make yearly on the account, different from the interest rate. It includes the compounding effect. So effectively your APY will be more than just your interest rate, because calculating that interest on interest. I think the one thing it doesn't note in here is, and again, we talked about it a little bit earlier, is just making sure that we understand. A lot of times validating whether the fees that some financial institutions may charge are included in that APY calculation. Is it netted out of that to get your true yield on an annual basis? Typically, they're supposed to do that, but it's something that you should just be aware of. So this is kind of a back of the napkin, easy way to see, they call it the rule of 72. And it's a formula to see, okay, if there's a certain advertised APR, how long will it take to double my money? And so if you take 72 by the interest rate, the result will tell you, how long it is to use $100, how long it is to double that $100 based upon compounding interest. Assuming it obviously assumes that there's no withdrawals of your deposit, or that interest rates are stable, which over a longer period of time they're not, but it gives you a good sense of what it means. I think there's some examples down, well, maybe, yeah, there is another examples here, but just to give you an idea, you have $50 in a savings account with earning 2% interest. So if you divide take 72 and divide it by 2, it's going to take you approximately 36 years. Is that right? 36 years to double that $50. So it just gives you how material that in the time frame in which that's can happen under that example, versus if you did it for 10, divided it by, well, this goes the opposite direction. If I wanted to see that return in 10 years versus 36 years, I can take that 72 and divide it by 10 years, and I would need to have a 7.2% interest rate to double my money within that time frame. So it just takes some of the guessing out, depending on what your financial plans are, midterm, long term, and understanding what's realistic with regards to interest rates in those categories, as far as how long I'm planning on locking up potentially my savings, and whatever your goals are, what's realistic time frame, and once I research a little bit what the average rate is I could get for locking up my savings for that long, what realistically my time frame is for doubling that initial investment. So this section, obviously, just to some of the key takeaways from it, some of the advantages, disadvantages to savings, where those options might be, and what it means as it relates to savings and interest rates and APY, et cetera. Let's go ahead and move on. We'll talk about, looking at my time here, making sure I'm not going too long, making sure I got time for questions if there are any. Saving, savings for unexpected events. I mean, Rita, you alluded to it at the beginning. Life happens, right? I mean, things happen to all of us, no matter what our financial position is. And we need to, this goes back to the planning part that we talked about at the very beginning in our goals. And we need to have goals for all of these events that happen to all of us in life, whether it's emergency, and these emergencies could be different too. I mean, you could have emergencies, my car breaks down, and I've got an older car, I know it's going to break down, I need that car to get to work every day, whatever. So I need to set up a savings fund, a short-term savings fund for the next year or two, and build that up, because I know I'm going to have to, replace the brakes or whatever it may be in the car. But then I need, other emergency plans or things that happen to us from a health perspective, maybe. I don't have, all of us may or may not have health care coverage, and a lot of it may come out of our pockets. So I need to plan for that and build that account up. And even though we seem very, very healthy today, accidents happened. I think, the picture on the prior slide showed a guy with a broken arm. Things happen to us in life, and we need to think about what all those categories are, what the time horizon is, how much do we need to save for that event to build up to, and kind of try to prioritize our goals, and what we're saving for at any point in time. This kind of slide talks about what I just alluded to. Things happen. Usually they're unexpected, and we've all had those before, and it's a huge bummer, and we got to dip into our savings. And we talk about it's a cycle, and that's why we need to be prepared as much as we can, and that's part of the reason for saving, obviously. Again, this just talks about, things come up unexpectedly, and they're in a cycle, but they're going to continue to happen for all of us. The more that you can plan ahead of time, the better off we all are, as far as, one, we don't have to rely on, borrowing money from somebody for when these events happen. We can handle them ourselves because of our savings. And it's something we just need to be really diligent about satisfying those short-term needs, is prioritizing those with savings, to be able to build up enough to accomplish that. Another aspect of moving on to the next slide is, things happen. Part of those can be that, whether it's your job, especially in this economy right now, in the area that I live in right now, a lot of people's jobs are tied to the tech industry, and there's been a lot of layoffs lately. And that, obviously, if you have prepared over time, some of those people are okay, because they can, they have savings to be able to lean on until at which point they can find a replacement employer and job. But if you have nothing, it makes it and you haven't prepared at all, it makes it really, really difficult to get through those times, because depending on the economy and everything going on, you just don't know what the next opportunity is going to be, and how long that time frame is going to take up. I think we talk about, in general, if you have the ability to, whatever your kind of your annual earnings are, that you're living off of today, if you can, a goal would be to save up 3 months of your earnings, because that could get you through 3 months of unemployment, is the theory. And so I think that's one that I've always tried to do. And sometimes those funds get stolen because of other emergency issues that we previously just talked about come up. But then that's the cycle we're talking about. Then I got to restart it, because I never know what tomorrow brings, and if I'm going to be employed or not, and I've got a family to try to support through that time until I find new employment. So that's a good goal for all of us. I've always stuck to that 3 months, and at times you know, during good times, sometimes you can extend that 3 months to be longer, get it to 6 months. You know, if you're like me and my family and events, then another unusual event comes up and it gets shortened again because I need some of those funds. But I think the takeaway here, going to the next page, is these emergency savings funds for a variety of things that happen in life make a big difference as far as your financial stability and health down the road, if you're able to save some amount of money for these events that might pop up. Moving down to, because I'm losing track of time here, but savings and goals. I think we talked a little bit about this, or I did, is it relates to prioritizing your goals. I think it's important having, understanding what your goals are, how much that will be today, that the cost of something, if I need to, I had to try to save for my kids going to college. Well, if you have young kids, the cost of college down the road is going to be significant more than what it is today. And so I had to do some calculations. Okay, based upon how college rates have increased, this is what it would be down the road. And so what are good things for me to be able to save to try to get to that point? And I'd look at, that horizon of being, depending on the age of your kid, what that horizon is. So I know how many years I've got and what type of return I would need to be. But I need to know also, like we talked about, that money is a safe place for me to access, that I'm not going to lose that money down the road. Everybody's going to have different risk profiles, but I need that money to be accessible for me once we get there. So that gets into the next slide, really, is being specific with your goals, measurable, what, go one more slide for me there, Aretha. In planning out, what the time frame is, how much I need for that specific goal. Other goals may be more short-natured, but again, that's where we're prioritizing our short-term, mid-term, long-term goals. I mean, even if we're just talking about saving $10 a month, you can prioritize that $10 to go to different categories down the road. I think the next slide here, to me, is probably one of the most important slides on this deck. And I use it in my life, not only for financial planning, but for all kinds of goals that I have. And I keep, and I have them categorized in different ones, and in different areas of my life. And I keep them on my desk at work, invisible, so that I can relook at them on a daily basis. And what that does is, I've done it before. I did it a long time ago. I'd write them down at the beginning of the year, usually New Year's resolutions. I'd write them out. I'd stick them in a drawer. Well, then it was kind of out of sight, out of mind. So I'm going to keep them out in front of me so they're focused. I can focus on those on a daily basis. Not that I'm going through each one, but it just reminds me of what I'm trying to accomplish.
Right. I agree with you, Devin. This is a very powerful slide because, if you see something, you're more prone to, keep your mind on it and say, I got to make it here. I got to get to this point. And so another good thing that I do a lot, and a lot of my family members, is we create vision boards. So whatever we want to achieve, like if it's a vacation to Hawaii for this year, we're going to put it on there on this vision board, and we'll stick it somewhere. We're going to see it every day. So we know when it comes down to spending money, that extra money, no, I need to set that money aside for this trip that I want to take, in the fall. So, it's just, And for those of you on here, if you don't do those kind of things, write stuff down or stick it on a Post-it in your bathroom where you can see it every morning. Stick it on your visor in your car, just somewhere where you can see it. Because when you see it, it's more easily where you to be achieved when you see those things. So just some things for you all to consider.
Yeah, most definitely. And I think these last couple slides here, Aretha, just kind of go through some of the things that we've talked about as far as budgeting for your goals and how much do those cost, and really putting the math down to be able to, back into, in your example, trip to Hawaii, how many members of the family are going, how much the plane tickets, how much is it going to cost for us to eat on a daily basis, how much is hotels, so what's the real cost of the trip. And then when are we taking that trip to kind of back into, okay, how do I save for the trip? I mean, the trip's going to cost all of us $1,000. That'd be great if a trip to Hawaii could just cost all of us $1,000, but I think it'd be a little bit more than that. But and then what's the time frame prior to that happening, so I can back into, okay, I need to save $10 a week in this example, and I have enough money for 2 years down the road. So that's it's same with this next slide. Most of our goals are large financial goals, but again, that comes down to the short term, midterm, long term. But definitely most of our midterm and long term goals are going to be larger dollar amounts. And so if it comes down to budgeting and how much discretionary, if we really track it down, most of us have a lot of discretionary expenses on a weekly, monthly basis, like my Starbucks example, that you can carve that out and really start to make a meaningful impact in your savings on a go-forward basis. Yes. So at the end, just kind of wrap this up and leave a little bit of time for questions if there are any, but and really encourage you guys to create a plan. I think that plan starts with a budget of what you're spending your money on today, really understanding where you're spending your money, what's discretionary. Then looking forward as far as all of the different categories. Again, I know I keep saying this, but short-term, midterm, long-term, what those things, identifying what those are, how much we need to have saved for each of those items, and then a plan. So, okay, now how are we going to get there? And even if it's just, it seems overbearing, it's just starting at the beginning, and you'll see over time that your financial health for you and your family, I think, will be much better off, obviously.
Yes, definitely. And I try to, when I'm counseling my clients, and I know, especially if you don't have that savings mindset, it just seems so overwhelming. But I'm telling you, all, once you start, whether that's $5, $10 every time you get paid, and slowly build that up, the next time, maybe $20. And once you get in the habit of doing that, you won't want to stop. You're going to see that savings growing, and you're going to be like, I got to keep doing this. I got to keep doing it. So if saving is not something that you regularly do, please do yourself a favor, get in the habit of doing that. And especially those, I know it's a lot of you on here and your goal is home ownership. Well, if you're not saving, as a housing counselor, I'm going to tell you right now, you're not ready for a house, because things are going to happen when you get in a house. And if you're not saving, and you don't have that mindset of saving, you're only setting yourself up for failure. And that's why I stress that so much in my counseling sessions. So I hope that you all are taking everything that Devin has shown you, like as far as how you can increase your savings, some of the options that you may have. If you don't understand any of that, some of the stuff that he was talking about this evening, get with somebody at your bank, have them explain that to you, and how those programs work, because a lot of times, it's a culture thing too. And I can say this as in growing up in an African-American family, money was really not talked about a whole lot, and I know I can probably get a whole lot of amens on here, but once you learn, that's when you do better. So educate yourself about different things that you don't know, the stocks, you know, the mutual funds, the CDs, all of that stuff. Educate yourself about that so you'll know if these are good tools for you to use in order for you to grow your money. So like I said, I hope you all take this information that Devin has shared and just run with it. And if you have questions, you know, you can go to your counselor. And I'm not saying that we know everything, because we don't deal with all the banking and all that, but we can certainly direct you on the right path, you know, put you in touch with somebody like Devin or somebody that can explain that information to you. So again, just reach out. And Devin, we thank you so much, but there was a question that came through and I wanted to make sure that I got it. Somebody said, is it wise to max what you add to your 401k?
Say that again, is it wise to match what you add to your 401k?
I guess to max out your 401k.
Oh, well, if you can, I would max it out, because what that does, I would max out the limit to one that fits in your budget. I think a couple things, I'm thinking about the question, a couple things to think about. One, what can you afford to do? Two, secondarily, if your company does any sort of matching, which we talked about is kind of free money, make sure you're fully taking advantage of that. And then when you contribute funds into your 401k, those funds reduce your tax basis. So it's not taxable. So to the extent that your budget allows you to, you want to put in as much towards the limit that you can. I think the limit now is for this year is like $30,000, or no, they keep changing it. I'm old enough now where I can put in more, I think, but I think it's maybe around $24,000, somewhere around there. It's a large amount of money, and to the extent that you can max that out, man, that's over time makes a material difference, and that's all reduces your overall tax liability at the end of the year too.
Exactly. Yes. Thank you, Devin. We had another question come in. It says, I have decent savings in a savings account that has 3.4% APR or APY right now. Would it be better to increase my savings by contributing more to my savings account or my 401k?
Well, again, although I work for a bank, this isn't something I do every day as a professional planner per se. What I would do is you're getting the whatever it was 3.4% annual percentage yield. Usually when you invest in your 401k, there's investment elections within your 401k, and so I think you need to look at that 401k and what is it being invested in. If it's primarily stocks and other equities, I mean, those can go up and down, and you may not over the long haul, it should be increasing, but it depends on the timing of what your age is, when you might need those funds, et cetera, and or the type of investments that your 401k is invested in. I mean, a lot of 401ks allow you to invest in stratify it in some sort of stocks and equities or mutual funds or even bonds and money market accounts also. So I think the key there is based upon your age is how you diversify your 401k with your contribution. So ideally, you've got healthy savings. If that meets those savings meet your kind of your short-term, mid-term goals, then I would definitely consider putting more, if you have that ability, into your retirement account.
Well, we're not going to keep you all. We're going to give you your 5 minutes back in the evening.
Well, I just want to tell you, thank you very much for having me. I really appreciate the opportunity. And this is, as you alluded to, this is really important stuff for all of us. And as I talked to you early, just going through and having to refresh myself personally, it's like these are great reminders to all of us as far as how important savings is and being able to write down our goals, et cetera. So I appreciate the time you guys were able to give me. Thank you.
Oh, thank you so much, Devin. We appreciate you. Thank you so much. Thank you all for attending. And be sure to check our calendar for the next webinar. You know, they're usually on Tuesday and Thursday evenings from 6 to 7. So again, we appreciate you all, and you all have a great evening. Thank you, Devin. Good night, everyone.
Thank you. Bye-bye.